Hello, welcome to another talk on money, business, and investing. My name is Jose. I'm the founder of the company and brand here at Master Investor. Ensure to subscribe and turn on the notifications so that you know when we go live or upload a valuable talk like this one that can literally change our finances forever as long as we apply the knowledge that we are learning every single day from our content. Our mission here at Master Investor is to elevate the financial well-being of humanity through high-quality financial education. Made simple, we look at opportunities to build passive income and true wealth. The time to start investing is today because that's how we're going to get experience. And we need the 3 E's of a master investor in order to call ourselves a true master investor. Okay, the first E is financial education. The second E is financial experience. That's when we're actively investing. We're not giving our money away. We're using it to invest ourselves. Okay, we're not going to give it to another company to invest it for us. We're going to learn how to launch our own companies, how to create those companies into true brands, which requires intrinsic value and business integrity. We talk about it all the time here in our community, and we show everyone how to focus on building the assets column. That's how we reach financial freedom and build true wealth, by investing for passive income, specifically always looking for that cash flowing asset that will bring in constant passive income. Okay, and we want to control assets. We don't necessarily want to sell them. Okay, so we want to acquire to control it for the constant passive income that is providing us, and then some assets will bring us capital gains income. Today's topic is going to be how to profit from financial bubbles, an examination of financial bubbles psychology, why financial bubbles occur, and what we can do to succeed no matter how the economy is doing. We prepare to cash flow on any type of economy. We don't sit here and predict the market because we know the market goes up and down. So be naive for a person to sit there and attempt to predict, while the master investor and the wealth entrepreneur knows that we can profit for any type of economy. In fact, when the economy is crashing, we can profit even more because the average investor is panicking and is making a lot of mistakes that we can take advantage of legally. Summary: we can survive a financial disaster by being aware of financial bubbles. Financial bubbles come and go. Therefore, we need to be able to know when to move, when, and how. To get financial bubbles, we must invest in our financial education. Also, I want to invite you to read our digital courses and ebooks that we have available on our website. You can find the ebooks on Amazon and Kindle if you like to have the paperback or the book through the Kindle app. However, when you go to our website, you will have additional assets that comes with each ebook. We have added more assets into the ebook so that we can emphasize on the topic, and we will do that ongoingly. So whenever we decide to get in whichever course, we can rest assured that whatever asset we add into that course, thereafter we will have access to that asset or assets at no additional cost. Okay, and that's something that we're doing for everybody here at Master Investor, for our partners that are getting into our digital courses and taking advantage of these great opportunities and investment to our financial education. That is a win-win, because in a year from now, the course is going to be a lot more than is worth today, due to the fact that we will have more assets, technology, exclusive interviews with wealth entrepreneurs, celebrities, and other people that can emphasize more on the topic of that specific course and ebook. And as we grow our catalog with courses, we will find that everything that we do here is to help all of our community and anyone that we come in contact to build more wealth successfully, like the ultra wealthy do. Exactly, following the patterns of the ultra wealthy, understanding the difference between an asset and liability, and expanding our vocabulary, specifically in business, because that's how we can acquire more wealth, by simply expanding our vocabulary. Our economic circumstances are unstable and even perplexing. Recently, inflation reached its greatest level in 40 years, and recession is predicted by economists everywhere we look. Since the start of the Great Recession in 2008, interest rates have increased. There are significant layoffs in many industries, notably in technology. However, job growth is still strong and the stock market is rising once more. And maybe for many, the world is in trouble financially, but we're not, because if we learn the new rules of money, we adopt the ultra wealthy mindset, we can actually take advantage of the setbacks of the economy, because people are still wanting to buy solutions regardless of the economy and the inflation. And when we understand how money is created today, then we be okay with inflation, because it's an effect of why money is today. It's an effect of the reason that money is a currency. It's not money any longer. It's not real money. Okay, so today our money is a currency, it's a fake money, it's an idea backed up by confidence, and we must understand that happened in August 15, 1971, when President Nixon separated the gold standard from the US dollar. And I explained this over and over again through our content, because it is important that our new members and whoever already have heard the change in the law on August 15, 1971, it's critical to keep in mind and present. That way we don't depart ourselves from the reality that today money is fake money, is monopoly money, is an idea backed up by confidence. Today money is created with debt, and we must understand that, because that is how the economy works. Inflation will continue to rise regardless of what the governments do to supposedly fight inflation. It's not going to happen, because the economy works with printing money. That's why we're over $34 trillion in national debt, and it will continue to be higher, because as the day goes, we print money every single day, okay? Digitally and also physically, which is fake money, it's monopoly money. And it's about 150, last time I checked, million notes that is being printed daily. That doesn't count the digital money that we're printing. So we have to add, it's probably in the billions, probably 6 billions, 2 billions per day. I have to check again. But the point is that inflation will continue to rise, so we need to learn how to print money like the government do, meaning that we can use debt, we can use the banks as leverage to make wealth, because we can use their money to invest in passive income assets. Okay, so we need to have financial education to be able to do this, and also raise capital successfully, because the banks are not going to give money to people that don't know what to do with their capital. They need to ensure that the asset's revenue will pay for that loan, and the interest rate and the debt service and whatever expenses comes with that. So out of all the chaos that people talk about, we need to learn how to look for opportunities. It should come as no surprise that a lot of investors are searching for a secure location to move their money in light of all this uncertainty. As we can see on our screen, if you're watching this on our YouTube channel, if you're listening to our podcast, because we're recording this at the same time on our podcast and different live streams. So if you're listening to the podcast, make sure you go to our website and subscribe to our YouTube channel, so that you have access to the articles via email, and also you can view the live streams when you have time to see them, as we share things on the screen that you're not able to see because you're listening to the podcast only here. Now, we can see that the graph shows gold versus fake money, and we can see that the gold maintains its value after it was separated from the dollar, right? It continued to maintain its value because its real money is limited, and the dollar continues to lose value. Same thing with the euro loses value in the yen, because after that change in law in 1971, August 15, when President Nixon separated the gold standard from the US dollar, from that point forward, money became monopoly money, like I mentioned, and every other currency around the world followed through that. So today, we also learned that the petrodollar agreement is being ditched. It's not being re-signed by the Saudi Arabia government, right? And that 1974 agreement is called the petrodollar agreement, which ensured that Saudi Arabia will only sell oil through US dollars. In other words, if you wanted to buy oil from 1974 all the way to now, or recently, like the last month, think it was due June something, when the renewal was done, and they said they're not going to do it. It's a big deal now because now they're going to accept other people's currencies, other nations' currencies. The other currencies are not obligated to convert their money into US dollars before buying oil. That's what the agreement is stated. In exchange, we were able to provide financial, basically advice, financial aid to Saudi Arabia, the infrastructure, and also military aid. So now, since they already built their empire over there and they're booming, they don't need to they don't need to rely on our help anymore because they can help themselves. So they're saying now they're not going to sign the agreement, and they're going to sell oil as they please to whoever they want to in whichever currency. And they're going to probably accept crypto as well, because today, as we learn, also crypto is the new currency. It's not just an asset or an asset class to invest to buy for capital gains income. Today is an asset class and an asset that has converted itself to a currency, meaning it's the new money in town. And it's been accepted by the Congress of the United States, and also other countries around the world are using crypto as their currency now. So everything is shifting, and we need to learn how to use these currencies that are available to us to get us to financial freedom and create true wealth. And the way we do that is by moving money into cash flowing assets. Transferring money or currency to a cash flowing asset. The distinction between money and currency is as follows, as stated in the past and in this post. The dollar is a currency in use today. Its value is subject to fluctuations based on many economic factors and how other currencies are doing. It can travel fast in either direction and is unattached. The Wall Street Journal reported in 2021 that the value of the dollar was dwindling. The New York Times reports a rising dollar is hurting other currencies today in 2022. What does it mean then that the dollar can be used as money? Discussing this subject in relation to electrical currencies is beneficial. Electricity is transported from one location to another using an electric currency. Any currency that wants to live needs to be in motion. In order to create wealth with currency, it must move from a cash flowing asset to another cash flowing asset, utilizing the 5 steps to the formula of velocity of cash flow. Number 1, acquire a cash flowing asset. Number 2, recoup the initial capital invested back. Number 3, keep control over the asset and its debt, if any. Number 4, invest the cash flow from the asset into a new cash flowing asset. Number 5, repeat the steps 1 to 4 as many times as possible. Now we can see on screen another diagram that shows the U.S. purchasing power and currency in circulation. The purchasing power has dropped significantly from January 1971 to June 2018. The U.S. money supply increased 32.3 times. This was accompanied by an 84.1% drop in purchasing power of the dollar, because as we print more money, what happens to the dollar? Since it's not backed by gold, it goes back to its intrinsic value, because the more money we print, the more dollars we print, the less valuable it becomes. Since 1971, it has lost about 90%, 95% of its value. It's not going to take another 30 years to lose the rest of the value that it has left. So we need to use that cheap money, that fake money, to make ourselves wealthy by putting that into real assets that are worth something, that are worth passive income. And when an asset is making passive income, it becomes more valuable because it's a freedom unit, it's a cash cow, it's producing money from thin air. Okay, so we need to understand the basics of business and investing. That's why we always go back and revisit them over and over again. And that's what we are here to do at Master Investor, to go back to the basics, to learn about the new rules of money, to implement the ultra wealthy mindset and the patterns that leads an ultra wealthy lifestyle, so that we can create the life that we want, regardless of the amount of money that it will require us to have in order to create that lifestyle. We can, because we have the knowledge to create money from thin air. We can invest for passive income. We know how to bring in passive income from assets that we are controlling with our companies, okay? So we can do that at any given time. So price inflation is a direct consequence of increased money supply. So in this economy, savers are losers and good debtors are winners. We gotta learn and master how to raise capital and how to get into good debt. Meaning that we're utilizing debt, credit cards, personal loans, any type of borrowed funds, other people's money to invest for passive income. And we want to see that passive income right now. It's not about waiting 10 years to get the passive income. If we're building a business, it's so that we touch that money ASAP right now. We don't want to wait years. Investing is not about waiting years. Investing is about learning how to utilize our money and putting it into a real business or build a real business that is solving a problem in the world. And because we do that so well through systems, the business is doing it and is feeling the need and is feeling and fulfilling the mission which the business was established with from inception. Then we get positive cash flow. We get total freedom from that success, right? That's what our reward is. It's getting that freedom that business will give us, because now it's giving us positive cash flow. We don't have to be present to run the business. The business is running on itself because it has systems. It could be one simple product that we launch. It could be coffee. It could be anything that we're passionate about, as long as there's a niche that we can serve, and as long as we have systems in place and we run it through the cash flow triangle, make sure that it has the 8 integrities of a successful business, then we can assure that that business will give us positive cash flow, and it will be a freedom unit. It will be a true asset into our assets column. Money dies when it stops moving. In a similar vein, the dollar's function as a currency is limited to transferring money between regions. For example, astute investors who anticipated the 2016 bond market meltdown most likely shifted their holdings from bonds to an industry poised to gain from rising interest rates and a strengthening dollar. Given the current high rate of inflation, astute investors are probably shifting towards commodities. Everything is cyclical, but the wealthy are aware that the real wealth is now found in assets rather than in volatile currencies during a financial crisis. With the possibility of a recession looming large over them, investors started gravitating into bonds in 2022. Now, these are investors that are average, investors that lack financial education, because we are against fake assets. And what are fake assets? Fake assets are those that only withdraws money from us and doesn't put any money into our pocket right now. So we cannot call an asset something that is just going up on value on paper. But if we're not seeing any money into our pocket, we can't liquidate that. We can't utilize that money that we're seeing. Then it's not an asset. It has to touch our account. We have to have control over the cash flow. And if it's not doing that, then it's not an asset. We cannot call it an asset regardless of whatever else everyone else is calling it. We need to make sure that we're labeling our assets what are real assets. And in our liabilities, we need to ensure that those are liabilities and that it's okay to have them as long as we have assets that will pay for those liabilities expenses. It's not about shrinking, cutting expenses. In fact, it's about the very opposite. It's about expanding and starting with our vocabulary. Exactly what we're doing here in our community every single day. Bring you the good and bad news of money. Teaching you exactly what works in any type of economy so that we can win, even when people are complaining. Despite shielding American investors' capital from inflation since 1978, so fake assets, mutual funds, 401ks, CDs, savings accounts, all of those are fake assets because they don't produce any passive income or capital gains income for the investor right now. Okay, so we need to ensure that we get out of those fake assets and shift that money into real assets that we control with our companies. Despite shielding American investors' capital for inflation since 1998, Series I savings bonds have never enjoyed it as much popularity as they do in 2022, according to CNET. For I bonds bought between May and October, the highest interest rate ever was created by skyrocketing prices toward the beginning of the year, 9.62%. The Treasury's computer system crashed when the record rate was disclosed in May because to the tremendous demand for I bonds this year, and the website suffered sporadic failures during the final few frantic days while the rate was accessible in the late October. Now, this for our investors that lack financial education, instead of looking into investing for that type of fake assets, right? Thinking that those are good assets for them, they're just running away from the reality of things. They're scared because the economy is crashing, so now they panic and they feel like they need to rushly invest their money somewhere else, and so they look for safe places, and usually safe places are not safe places. If you have no control, if you have no leverage, if you have no voice into the asset, that doesn't seem very safe to me. So, and for a wealthy entrepreneur and inside investor, doesn't seem safe at all as well, okay? The more control we have, the more leverage we have, even though it might be riskier, the rewards are higher. So we gotta learn how to manage risk because it comes with investing. No one wanted bonds for a long time. However, they are the hottest item on the market due to increased inflation. So people panic, and so they go back to those fake assets. A plethora of articles about where to get them have just been released. This whole thing indicates that money is changing and people lack financial education. That's why here at Master Investor, we devoted to fulfill our mission, which is to elevate the financial well-being of humanity through high-quality financial education made simple. We look at opportunities to build passive income and true wealth. Burst financial bubbles. Money is not longer money. It's not a currency, which is why it is not surprising that financial bubbles frequently burst. An asset that has had its value artificially inflated by investor enthusiasm and occasionally hysteria is referred to as a financial bubble. Financial bubbles expand endlessly before popping, just like actual bubbles do. The bond market is an imminently burstable bubble. There is a bubble in the housing market that looks poised to burst. The stock market has also experienced significant volatility. The bubble that was cryptocurrency burst really violently. Like in any financial bubble, the majority of inexperienced investors will enter the market later and will probably lose money, while the smart money has already moved on to the next promising asset. The story of financial bubbles is in all as time. Financial bubbles are an inevitable part of life, just like death and taxes. They have also been in existence for a while. Tulips were implicated in one of the greatest and funniest financial bubbles. In summary, the price of some varieties of tulip bulbs, a highly valued flower, rose dramatically between 1634 and 1637. Things took a very hot turn in 1636 to 1637. Alastair Sock, in a piece for the BBC, provides a clear description of the situation. One of the peculiarities of the 17th century tulip market was that bulbs of rare and valuable types were traded rather than the actual blossoms. As Dash knows, the outcome was what would be called a future market today. Even as a sort of a currency in and of itself, tulips were utilized in 1633 when real properties were auctioned for handfuls of bulbs. A single bulb of Semper Augustus was already valued at an incredible 5,500 guilders in 1633. 1633. By the beginning of 1637, this had nearly increased to 10,000 guilders. Dash contextualize this amount at any time when homes in the city were as experienced as property anywhere in the world. It was enough to feed, clothe, and house a whole Dutch family for half a lifetime, or sufficient to purchase one of the grandest homes on the most fashionable canal in Amsterdam for cash, complete with a coach house and an 80-feet garden. Early in February 1637, the tulip market crashed. Flowers lost all of their appeal and were now worth a fraction of what they once were. As a result, many faced the possibility of financial ruin. However, instances of financial bubbles in the present day are also easily located. The financial bubbles of banks. The Wall Street Journal revealed in 2010 that bargains on failed U.S. banks are over. The article claims that investors were pulling out of deals to purchase failed banks from the FDIC because the prices were getting too high, even though it was predicted that there will be more bank failures in 2010 than in 2009. The average buyer purchase gain as a percentage of assets was 2.5% in 2010 compared to 4.5% in 2009. The average discount on failed bank assets was 9.5% versus 14%, and the average cost to the FDIC of loss sharing packs as a percentage of assets was 22% versus 27%. As absorbed as it may sound, by all accounts, some investors were paying more, which increased the price of failing banks, even as the market was worse and more banks were failing. The financial bubble of gold. In other article from 2010, Bloomberg.com titled "Gold Railing to 1500 as Soros Bubble Inflates." It was reported that the December gold future contract was trading at 1500, an increase of 18% over the record gold price of $1,266.50. Said on June 21st, 2010, the article claims that George Soros, who referred to gold as the ultimate asset bubble, and generally at the Davos World Economic Forum, was among the largest buyers of the metal. It seems that even with the record pricing of gold throughout the summer, he believes that the bubble in gold assets is still young. Gold reached its peak in March 2022 at $2,606. In other words, George was correct. He most likely made a huge fortune. People who bought close to the top didn't. The current price of gold is about $1,700. The financial bubble of GameStop. Consider the madness at GameStop, for instance. As stated in the article, GameStop retail investors and the 10 controls of the sophisticated investors, GameStop stock reached a high of $380 on Friday, January 29, 2021, making it one of the most traded stocks in the market. In the midst of a pandemic, how did this happen to a mall retailer with an antiquated business model? Euphoria was the response, leaping in to take advantage of a rocket right are amateurs. Eventually, GameStop dropped to about $40. It is around $11 right now. We can bet that many people made and lost a lot of money during their journey, but all of it is gambling. Bubbles in cryptocurrency finance. Maybe the best illustration of overpaying is the Bitcoin industry. Unfortunately, a lot of individuals buy when the price is at its highest, way too long, and then become hesitant to buy when it falls because they believe they have lost money. The peak price of Bitcoin was $64,400 on November 12, 2021. Since then, it has climbing to 71,678 as of the writing and fallen as low as $16,416. Professional investors most likely bought on the dip along the way, while all the immature were selling and lost money. Numerous tulip craze exists today. Should we believe that a phenomenon such as the tulip craze was a historical aberration caused by retrograded people from the hundreds of years ago? All we have to do is consider our own contemporary crazes, such as the tech stock bubble of the early 2000s, the subprime crisis of 2008, and even the designer fruit craze in contemporary Japan, where a square watermelon can fetch up to 20,000 in their currency. In every case, logical people have succumbed to the herd mentality and purchased and sold things at prices that did not correspond to their true worth. Investors frequently use the argument that they are operating in a new paradigm and that the current situation will never change to defend their choices. Usually, it is not the case in reality, quite the contrary. So, make sure that you're not following the average investor's advice. You're attaching yourself with the ultra wealthy mindset. We're operating with the ultra wealthy context, which is more important than the content. As we can see again on our screen, we have the cash flow tetrahedron, which shows us how we should be investing through our businesses for passive income, and the revenue of those businesses is paying all of our expenses. And within those expenses, the first expense we have is investing in financial education. And so that cash flow that is coming in from those businesses, or a business that we created, whether it's our first business or our second or many other businesses that we have, that revenues and surplus we're going to use to pay our expenses and of course set the ground for other assets as we grow our wealth. So our revenue will buy us other assets that are cash flowing today. Financial bubble psychology, all of this raises a question of why people will overpay for investments. Today, investors often believe that the good times will last. They sincerely think that they are in a new paradigm. Here are 3 causes for this way of thinking. Anchoring. Number 1, the tendency of an investor to anchor to a price that is significant to them, even if it may have little bearing on the market they are investing in, is known as anchoring. For instance, concentrating on double our investment and holding off on selling an asset until the price hits this target. Number 2, loss aversion. Most people find it painful to recognize a loss, so they will do everything in their power to prevent it. This implies that an investor is willing to wait in the hopes of breaking even if the asset's value is less than what they pay for it. If the asset is nearing the end of its useful life, this could be disastrous. At most, it indicates that we have money that could be better used elsewhere, but is instead locked in a bad performing asset. Number 3, herd behavior. We are taught to give in to peer pressure as the easiest way out at a young age. We get comfort in the fact that others are investing in the same way as ourselves. If, for instance, everyone is purchasing pricey internet shares, we can rationalize our choice by telling ourselves that all of our friends are doing it and they are making money, so it must be okay, despite our reasonable brain telling us that this is insane. Buffett must know better than to engage in the 3 activities. Being among the wealthiest individual globally, he resists the allure of the market frenzy. All he gains from them is profit. How? Buffett stated that he believes stocks may still be inexpensive a few years ago, when they were once again hitting records. Buffett made a crucial disclaimer when he said that stocks appear inexpensive because his assessment was predicted on a low interest rate environment. If interest rates were 7 or 8%, these stock prices would look exceptionally high, he stated. That is the distinction between an amateur and a professional investor. While amateurs chases acceleration, Buffett invests for fundamental market reasons. With interest rates rising today, we can expect that Buffett will leave the market well ahead of the amateurs, who will profit handsomely while others suffer significant losses due to the fact that we have financial education. The more we know we don't know, but the more we know about money and business and investing, the better chances we have among everybody else that are only working for earned income. They have no financial education. Every day they don't invest in their financial education, they invest in somebody else's ideas and dreams, right? And they're leaving their own dreams to the side. So now, if you love your job, you still need to learn how to invest, because at some point maybe you don't want to work there and you want to have the same type of lifestyle that your job was able to provide you. Now the only difference is that we're going to have assets that will provide passive income and capital gains income, where we don't have to ever work to make that money. Our assets are working for us. Our investments are making that money for us. What will we do in our case to avoid being an average investor and instead become an inside investor? Phase 1, a wave of financial shocks. A disruption in the existing economic status quo triggers the start of a financial crisis. It might be a new technology, as in the dot-com boom, a conflict, or cheap interest rates. Phase 2, acceleration. Not every financial setback results in prosperity. Fuel is what is needed to start the fire. Fear following the 9/11 attacks, which resulted in a stock market meltdown and drop in interest rates, most certainly drove the real estate boom. The largest real estate boom in history occurred as banks and the stock market poured billions of dollars into the system. Phase 3, feeling of joy. If an investor has missed the present boom, they will know to hold out for the next one instead of making a hasty investment. But the greatest foolish rush in when acceleration transforms into pleasure. By 2003, real estate was becoming the domain of the foolish. Talk about the housing market app. Parties became very popular. The term flipping gained popular during PTA gatherings as credit card borrowers took out long-term loans to pay off short-term debt. Homes become ATMs, and if they were just managed correctly, if those funds were able to be put into real assets, then maybe those people could have made it work. But the people that pull out their money out of their houses because their house went up in value due to the inflation, and they feel like they were becoming wealthy, and they utilize that same money to either pay for other bad debt that they had, and it didn't create any more money for them. Instead, they should have invested that into a real asset that will produce passive income constantly, so that they could use that to pay the bad debt and also pay back the loan and the interest rate that it came with. So we need to look at how we touch and how we move our money. Okay, every single dollar, every single credit card or any loan that we have, we need to ensure that we are putting that into real assets. Okay, if you're just buying liabilities, then you're definitely not going to ever reach financial freedom. We have to learn how to utilize that money to buy assets. Mortgage companies push for more loans by running advertisements on a regular basis. Financial advisors became mortgage brokers because they were fed up with having to tell their clients why their retirement plans had lost money. In this euphoric time, novices thought they were real estate experts. They will brag about their wealth and intelligence to anybody who will listen. Again, they thought they were wealthy because their houses went up in value. And not only that, they utilize that money to invest in the wrong place. They didn't put it to work correctly because they lack financial education. So it's not money that makes us wealthy necessarily. It's the financial education that we have, because a person without financial education is gambling with the money. But a person with financial education does not gamble with the money. We know exactly how much money we're going to get back, how fast, and where, and when, and everything. We know every single detail about the investment because we create the investment or we put it together. Phase number 4, a financial crisis. Outsiders buy from insiders. Now the bigger idiots are piling into the snare. The people who saw prices rise for years while saving out of the market because they were afraid to enter are the last fools. Eventually, the exhilaration and tales of acquaintances and neighbors striking it rich and the market catch up with them. Finally, greed overcomes the skeptics, beginners, hesitant, and latecomers, and they rush into the trap with cash in hand. Before long, sorrow and reality set in. The bigger idiots are aware that something is wrong. When panic sets in, they start to sell. Regardless, matter whether it's stock, bond, mutual fund, real estate, or precious metal, people start to despise the item they previously adored. Phase 5. The boom becomes a bust when the market reverses. The novice start to understand that costs don't always rise. They might observe that the experts have sold and aren't purchasing anymore. When prices start to decline and buyers become sellers, banks start to tighten up. Minsky calls this time frame discredit. This is when God reminds us that we are not as smart as we thought we were. Losses begin to mount as the easy money disappears. The bigger fool in real estate understands he owes more on his property than its market value. His finances are in disarray. Phase 6. Fear sets in. Today, amateurs despise their assets. When prices drop and banks stop lending, they begin to dump it. Panic increases in speed. As of right now, the boom is a bust. As is frequently the case with the stock market, regulations may be put in place at this point to limit the decline. People start searching for a lender of last resort to save as or if the decline doesn't stop. This is often the central bank. The good news is that professional investors start to become thrilled again at this point, waking up from their sleep. We resemble a bear that has been hibernating and wakes up to see a row of trash cans outside our lair, bringing with costly food and champagne from the previous night's celebration. Phase 7. The arrival of the white knight. Every now and then, the bubble bursts completely and the government is forced to intervene. This is what happened after the 2008 catastrophe when it purchased stock in GM and other huge Wall Street institutions that had taken on excessive leverage. What stage do we think we are in right now, and how can we take advantage of it? Fortunately, there is a 5-point strategy that can help us make money in any market. The 5-point master investor strategy for making money during stock market corrections. The first step to success in any market is very apparent, yet it is overlooked much too frequently. Find out where our money is being invested. Save our money in a 401k and leave it alone if we don't intend to invest in financial education. That is what majority of people do, and that's the problem why they don't ever achieve wealth and they end up working the rest of their life and they never figure out how to make money work hard for them. A lot of times The 401k pension plans are the worst things a person can invest in because it's just withdrawing money out of their pocket. And if you're not willing to become wealthy, if you're not willing to take control over your time, make your own decisions, take control of your financial future, then a 401k is probably the answer for that type of person who doesn't want more out of life. But if you want to take control of your finances, cash flow, and create wealth, then you need to learn how to put your money into real assets that your companies control. Compared to transferring money without understanding how or why, it is safer, right? So however, we must know how to turn that money into our advantage if we want to be ready to profit in any market. As we can see, we have the diagram of the cash flow pattern of the poor class. They have a job. All they do is they earn income, and then they pay the expenses to someone else's asset column. They have no assets. Usually they have no liabilities. They lack credit. And so they have only expenses, and they have no liabilities. Reading Master Investor's article is a terrific place to start. The 5-point strategy are: number one, recognize our role. The unfortunate truth is that the majority of people have no idea where their retirement funds are invested. Like I said earlier, lack of control, lack of leverage, lack of voice. That is not a master investor, right? So if you're investing in things that are taking your control away from the asset, then that is not an asset. It's not an asset that we want to get involved. It's a fake asset. It's not producing passive income. We have no control over it. That's not the type of real assets that we're talking about here. The funds are taken out of a check, placed in a managed investment account, and are maintained by a financial manager who is a genius according to them. Number two, be aware of our performance level. Once we are aware of the investments our money is made in, we must ascertain how well those investments will do in a particular market. The majority of investors' retirement funds are made up of equities and bonds, so there's a considerable probability that they will decline if interest rates are raised significantly, as the Fed appears to be planning to do eventually. It might therefore be a good idea to buy real estate in such a market before interest rates rises, because if all you're holding, or all the investors holding, are stocks, right, equities, stocks and bonds, then it's going to decline once those interest rates begin to rise. Number three, become knowledgeable. That's why we always say diversify includes the 5 asset classes, not just one asset class. A lot of people that talk about building wealth, that are the wrong mentors, they tell their followers to invest in one asset class only and diversify among those among that one asset class, not knowing that there are other classes that we can invest in. So there are a total of 5 asset classes that we can invest in. Number 1, business. Number 2, real estate. Number 3, crypto. Number 4, paper assets. Number 5, commodities. So choose one. I suggest to start with a business, because that business will produce passive income and can buy us other cash flowing assets. And that's the holy grail of investing, when we have businesses buying other cash flowing assets for us. Everything is free at the end. Number 3, become knowledgeable. This implies that we must educate ourselves financially daily in order to recognize what's coming and have time to prepare. We cannot simply rely on advice regarding the market from other people. We need to look for that advice ourselves, get into the midst of everything that is happening in today's world of money, right? We have to seek financial education every day and invest in it, right? So choose our mentors wisely. Make sure that we go out there and look for the right communities, the right people that can help us achieve what we truly want, because they already achieve what we want to achieve. Number 4, reduce our risk gradually. With the right knowledge, we can make better predictions about the direction of the market, the performance of our present asset, mix in the upcoming markets and our level of risk. This enables us to choose positions that will perform well in an up or down market and make the necessary adjustments to reduce our risk. And that brings us to our last point. Number 5, purchase in pairs. Traders with experience always purchase in pairs. There are 2 positions, one for protection and the other for expansion. For example, we should consider taking an insurance position in commodities or precious metals if our portfolio consists primarily of paper assets in the stock market. It is advisable to purchase insurance for any real estate we purchase. There's no end to the list. We should always invest with insurance. A master investor invests with insurance. We always invest to win. Even when we lose, we win. Naturally, financial literacy is required for this, but the investment pays off. As we can see, we have the cash flow pattern of the middle class showing on the screen. Either the person is a doctor, a dentist, or an attorney, could be an accountant, some sort of profession, right? The person still has a job, makes a salary, maybe has a small organization, but it's just them. And so they still have to work for money, for earn income. They lack systems and financial education, so their income shows up like this. It comes from their job, right? They have to show up to see their clients, even though they get paid probably higher than the poor class, of course, right? Because they have a profession, they graduated, they have a license of some sort, so now they can charge for those skills that they acquire. So their income comes from a job, comes from earned income, and it flows into their income column, and it goes down to the liabilities column, up to the expenses column, and out to somebody else's asset column. So the difference between the poor and the middle class is that the middle class makes more money because he or she has more skills that they can charge for, and also they have the ability to acquire liabilities more than the poor class, because the poor class requires more income to be able to acquire liabilities. Some of the poor class may have some liabilities, right? Because depending on where we are in this world, the country allows us to acquire liabilities easier than other countries. Why acquiring? But the point is that they work for earned income, the middle class and the poor class. That's why when it comes to money, there are two types of mindset, the poor and the wealthy mindset. And the poor has the middle class and the poor class in it, because it's the way they operate their money, it's the way they make their money that makes them have the poor mindset. So it's not money that makes us wealthy, because there are a lot of people with money, but yeah, they're not wealthy because they have no freedom, they have no control over their time. Why acquiring financial literacy is essential for surviving financial bubbles. Regretfully, the typical investor is ignorant of market fundamentals, let alone how interest rates affect stock values. Simply put, they buy because everyone else is doing it and the market is rising. This raises an intriguing question too. What is the opposite of herd mentality, loss aversion, and anchoring? And how do we successfully implement the 5-point plan? Financial education has the solution. We can spot trends and make money from them if we have a solid understanding of how money and markets operate. That is exactly how Buffett and others alike have amassed our wealth. Investing in our podcast, products, and courses here at Master Investing could be a fantastic place to start and maintain our wealth growing. If we wish to improve our financial literacy, then we need to invest in the right mentors, and we need to be dedicating time towards our financial education daily. The world has great and real teachers that can help us achieve true wealth. Find and invest in our mentors. Now we have the cash flow pattern of the wealthy class. As we can see, the income is made through passive income or positive cash flow and capital gains income from assets that we control among the 5 different asset classes that exist. So our assets produce our income, and then it flows to the income column, goes down to the liabilities column, up the expenses column, and a lot of the expenses are our assets, so it goes back into our assets column. So we recycle our surplus and our money back into our assets column by creating good expenses. Not all expenses are bad. That's why I said earlier, we are going to be expanding all of our columns on our financial statement. Specifically, we're going to ensure that our assets column grows continuously. Because if it doesn't grow, then we can't really grow the other ones. And if we grow the other ones without growing the assets column, then we'll find ourselves in financial trouble. However, it doesn't stop there. For example, we will gain a lot from learning under our content if we were interested in paper assets in any other asset class. We need to invest in our mentors. We have to learn from other people's mistakes. That will be the fastest way to avoid making those mistakes ourselves. We don't have to make mistakes ourselves, okay? We can learn from other people, and today we have access to all the information that we can ask for. And that's why organized information is worth a lot of money. It's worth a lot because it gives us the time, right, that we need to be able to get what we're looking for, right? So if we are looking for something, how to do something, and we start looking online, since all the information is there, it's going to require us more time. So by paying for organized information, now we have 10 chapters, we have 10 steps, and it's coming from the right reference. So we don't have to look for the information in the big garbage can, for lack of a better word, of information that we have available, because not all information that we find online is truthful. We need to sort it out. We need to ensure how to tell between the difference of facts and opinions. So when we go into investing, we're gonna go with facts. When we measure our return on investment, on any investment that we are going to make, it has to be measured with facts, not with opinions. We can master how to make investments like Buffett, not like most average investors. A hint, it is not as simple as buy, hold, and pray, like many do. Those are traders. It takes more than that poor strategy. It takes understanding how to acquire and build real assets. We can create cash flow with stocks by utilizing advanced strategies explained in great detail inside of our volumes and courses. If we have the correct financial education, we can prosper when others are barely scraping by. To actually grasp how money works and how to make it work for us, we just need to go past concepts like herd mentality, anchoring, and loss aversion. It does not take only money to make money. It takes financial education for us to be able to make money, make more money through sound investing. A person that lacks financial education, he or she lacks control, knowledge, and is gambling when investing. We invest to make passive income instantly. We want to see that coming into our bank account. We want to control the asset. We want to control the company that owns the asset. We want to turn that company into a real brand because we are adding intrinsic value, meaning that we're protecting the logo. We have a patent. We have intellectual property. Our legalities are in order. We have the 8 integrities of a successful business established inside of our business and organizations, right? We follow in the cash flow triangle with the 8 integrities: mission, team, leadership, cash flow, communications, systems, legal, and product. We focus on building passive income and making money multiply through sound investing. And in order to be financial bubbles, we must have financial education and the ability to raise capital through sound investing. Okay, when we have an investment that is sound, money will find us or we find the money. And when we have money of our own, we gotta use that money to raise more capital. Okay, so before we go and use our money, let's use our money to think how we can acquire more capital and use other people's money legally, right? A credit card from the bank, a personal loan, etc. There are many private lenders today that we can access online. Our next ebook is called How to Raise Capital to Invest to create wealth. That's what it is. And then we have 3 books right now: The 10 New Rules of Money, How to Build Cash Flow with the Internet Term Passive Income On, and How to Invest in Crypto to Build Wealth. You can find the link in the description of this talk. Make sure you access our digital courses today, because as we grow them, every course is growing because we're adding more assets, the price will also change. So we want to get in right now so we can lock in that price and have a great deal, because every asset that we add in there, at the time that we get in, anything after that is for us to keep at no additional cost. So take advantage. I hope that you learned a lot from today's talk, bring you the good and bad news of money, the business principles that work in all economies. Today we cover how to profit from financial bubbles. Let me know if you have any questions. Thank you for having me, bringing you the knowledge of money so that we build true wealth. Stay extraordinary and wealthy. I'll talk to you in the next talk. Bye for now.